Awesome. Hello, everyone. Thank you for joining. This is Gul from Metal. As you know, a lot of you and most of you know, Metal is building super intelligence for fundraising. We are bringing intelligence to all the core workflows involved in fundraising. This is an event hosted by Metal. We have two amazing speakers here, both of which, I've known Sasha and Ahmed Omar for many years now. I'm really excited to sort of have the session and introduce them to everyone. So for a quick background, I'm Gul. I'm the founder and CEO at Metal. I raised 120 million for my first startup, and that's actually how, the idea and genesis for Metal was born. And we have here Sasha, who, built a company called LendUp, that raised, more than $200 million. And now he's building Puzzle, which is accounting software, where he's raised a little over 60 million. And then we also have Ahmed Omar joining from Sully.ai, who's raised 40 million for his startup in healthcare. Sasha, over to you. Would love for you to, maybe start off with introducing Puzzle, and then we can move over to Ahmed, and we can dive into the agenda.
Yeah. Hi, everybody. Great to be here. I think not too dissimilar. I'm starting a company to solve one of the problems from scaling my first company, which is accounting. And so we're building modern, more agentic version of accounting. Think of it as an equivalent to QuickBooks. And we started with startups, for venture-backed startups. It's built native to the modern stack. Kind of like, you get to use Stripe and Gusto and Brex and Ramp and Rippling and then you have this 38-year-old piece of manual software called QuickBooks. So we're trying to bring that up to modern expectations. Yeah, so that's me.
Awesome. Thank you, Sasha. Omar, would love for you to introduce yourself and maybe share a little bit about Sully.ai, and then we can dive into all things fundraising.
Sure. Yeah. My name is Ahmed Omar. I'm the CEO and co-founder of Sully.ai. We're transforming hospitals from just human-led hospitals to human and AI so that they can have more capacity to see more patients. That simple. We're doing all the human roles that used to be done on computers and, go back into the hospital. You see people typing in, calling patients, doing data entry, schedulers, and there's very little efficiency. We're basically automating all that with agentic workflows and AI. We started bit earlier than we called it medical staff, synthetic staff before we came up with the word agents. So yeah, but that's a bit about us.
That's awesome. No, thank you, Omar. We'll dive right in. So one of the questions we get all the time from founders that we'd love for to start with is maybe Sasha, we can go to you first, and we'll come back to Omar. But when you're first starting out, right, like when you haven't raised venture capital before, you're just starting out on your journey to raise VC, right? Like you don't know investors, you don't have a network, right? Maybe you're not from the Bay Area, right? And so, Sasha, if we go back to, before Puzzle, before LendUp, right? Like the very first time you decided I'm going to do a startup, right? Like how did you sort of get in the door and get, like your first few sort of investor meetings, how did you navigate sort of just getting in the room? Was it easy? Was it hard? Was it straightforward? And what was your path to getting there?
Yeah, good question. I think I'd reframe the question a little bit more of like how hard or how easy do you want to make it for yourself? And each of these are sort of these concentric circles and these rings that kind of go further out. So how do you make it easy to have an investor? They know you and they like your business and they like you. How do you make that happen? You know them over time and you keep sharing with them what are the things that you say you're going to do, and do you do them? And you do them in a big TAM. And then and you have that relationship over time. All right, so what happens if you have a cold start problem? So how do you do it? It's harder to do it if you're not in San Francisco or New York. So how do you solve that? You get an airplane and you fly to San Francisco or New York. How do you make that even easier? You stay here for a while and you go to events. There's events all the time. Last night I was at an event with Reid Hoffman and Aaron Levy talking about like the impact of agents and AI. There's events every night in San Francisco, I think, like multiple events every night. So you go to these events. You go to the events that happen to have venture capitalists at them. How do you make it next easier? They know who you are. How do they know who you are? You like tell them something interesting and relevant, even if you're not fundraising. You hit them up on Twitter. You like their comments. You post on their comments. You reach out to them. they're going to ignore you. They're going to say no, but just you get that name recognition. Then you show up at an event. Then when your business is ready to fundraise, you're like, you're top. They feel like they know you because they've interacted with you. They've seen you. You've talked with them, and you're their job is to invest in companies. So it's not like you're like annoying them by like pitching them. That's literally their job. You make it easier by taking your amazing company and your passion and your problem solving and you're pitching. So like, don't feel bad. It's just kind of like a slightly different sales funnel.
Awesome. Love the framing around how easy or how hard you want to make it for yourself. I think that's great. Omar, how was it for you? Was it easy? Was it hard? How did you go about it?
I don't think anything is easy. I don't think anyone in this call wants to do easy stuff, right? So I think about this often. I think from my perspective, it's very easy to raise money when it's all about passion and it's coming out like some of a problem you really want to solve. So even if you don't have experience, so what I did is basically I took a job behind the desk in one of the hospitals in the Bay Area as an admin, right? Like I was basically answering phones and just like understanding what workflows they're going through, how do they verify insurance, what happens when someone cancels, right? It just stays there. The doctor just wasted time. Nothing happened. So I think one of the first things I do, like before raising any capital, is just understanding the problem on a deeper level and living in the problem. So even if you're not a user, for example, targeting a clinician, I was never a clinician. So you could live with the clinicians, right? I think that's one of the first things that I would do to make it very easy for you in order to understand the problem. And then if you understand the problem, you felt that you're really passionate about solving it, it becomes very easy to raise money from angels. So I would say like I never really targeted any VCs, like pre-seed, seed, never really targeted any VCs. Even the person that anchored our seed round was an angel who would put, $1.5 million or 2 mil, and then it anchored a VC to put, to close an 8 million seed, right? So I think picking a problem that you really want to solve could make it very easy for you. Because if you would not be paid for like 6 months, a year, and you would still do that, solve that same problem, I think that would make it very easy for you. Versus just trying to fake it till you make it. Kind of.
Right. No, spot on. And that's, sort of a unique sort of experience and perspective, let's fast forward here, right? So this, seed, series A, right? Different ball game, different challenges, different equation altogether, right? And in such, you've done series A multiple times, right? I guess what are, when you think about like seed, when you think about series A or series A in particular, right? Like, what are, how do you sort of go about the decision on like, okay, now we're going to go and raise a series A round? Is it like purely metrics driven, right? Where it's like benchmarks for ARR? Is it more for, when you're ready to like really scale things up and you need that capital to sort of scale up? Or is it more driven by none of that and more like, when you feel like this is the right time, there's a lot of investor interest, I have all these like investors that, are hovering around the company and they want to talk and there's interest. So let's just capitalize on that interest. Like, what is your sort of guiding light post on how you sort of decide what's the right time for a given round, whether that's seed or series A?
Yeah. Whew, that's a good one. So there's if we look at the matrix of like seed and A, let's just call that for like sort of the beginning of institutional capital, and then we look at the other axes, is like metrics versus story, and we're sort of thinking about where do we fit. So generally, the best businesses are the ones that are just growing revenue fast. And those kind of trump every matrix. If that doesn't happen, which means your business isn't like ready for venture capital. So seed is a lot of story, like what's your passion, and is it a big TAM? And you don't really need metrics as much. If you are known, if you're not known, you need better metrics. Again, it's just sort of like the how hard are you making it for yourself? Like the best businesses will get funded and the best entrepreneurs will get funded. And the best entrepreneurs with the best businesses will get funded, right? So if we go back to Omar's thing, like if you're showing a passion for a big market and you have growing revenue, like your job will be choosing what investors. If you are like a world-class entrepreneur and you don't have an idea, you will still probably get funded because you're just like, I'm going to find a market and I'm going to make it work along the way. And if you're not, then you have to have a higher standard. And so if I think back to like my first company, um, we had a big market, but we had capital constraints to get into the market. And so I had to be story because I couldn't generate revenue until I got licenses and I got funding. We were building a mobile lending business along the way. So I had to become a world-class founder, or at least I had to have the appearance of a world-class founder. And so I just like watched a lot of videos and I read everything I could and everything on YC. And I was like, how do they talk? How do they speak? What do they think about? How do they act? What do they do? There just weren't a lot back then. But like that's what you had to do. The challenge is when you're usually a small seed company, like we all were or are, when you are leaving to go fundraise, your business is usually suffering because your sales and product and engineering and like finance, you're like everything, right? And so you just got to have to time it the right way. And that's why I think back to Omar's part, you prepare. Like the more that you are prepared, the better it is. Build the network, build the story, get everything ready so that when your business hits that inflection point, you're ready to fundraise. So this was the difference between seed and A. Seed, I did just build confidence that I didn't have. I had to stomach through all the rejections of no, 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 no. You don't have shit, so I'm not going to give you money. And you just had to like find that one investor who was like, I believe in this no-name person, this guy. And so yeah, that's like what you had to do. When seed, it was like, all right, now, I mean, Series A, when the business was ready, it makes it easier. So I was just prepared. I had the story ready, I had the data room ready, I had the cap table ready, I had everything ready. And then I was just waiting for the business to like hit that inflection point. And as soon as it hits that inflection point, I had my network, everybody that passed on me before, everybody that I found on the internet, everybody that I warmed up, and I was just like ready to go. And so by the time you're ready to go and the business is ready, like it just increases the chances of success. Listen, I still got lots of no's. I still get lots of no's, but the majority of them are no's. But you know what? It only takes one yes. And so, you just gotta power through. But the more that you have a bigger network, the more your CRM is. Let's think about it like a sales funnel. The bigger your top of funnel, the more chances are, and you only need one at the bottom to say yes. 100 leads that are not relevant is like not relevant. You gotta there's more work in there. You want to find somebody that's the right stage, likes the industry, isn't it a competitor, like hopefully that has somebody that's interested in you. But like it starts with the bigger list and being prepared with a business that is venture fundable. Yeah.
Right. So Series A, do it at the right time when the business is ready from a metric standpoint. Seed is willed into existence, and it's more about the story and the TAM. I guess there's one question on the chat that I think is a great question, and it relates to, Sasha, what you said about network. So the question is, there's advice against talking to investors when you're not raising. What's your opinion?
I think it depends. Like my general gut is don't waste your time if you don't have your story prepared, because a worst first impression is worse. So like taking a meeting, generally, no. If you have your story and your talking point and your business is like reasonably venture funded and you can speak confidently, but you're not ready to raise, but you will soon, or you feel it's getting there, that I think is a good time. And just remember, like most of the outreaches, if you get one from a VC, are like an AI SDR that's hitting you some cold email. You think they're not going to talk to you in like another month or two? Like that you're on a CRM list. Their job is to take meetings with you. If you're already on their radar, they're going to take a meeting another month or two.
Right on. No, that's great. Omar, would love to, hear, so I know, Sully is an interesting business. I think you've very successfully raised capital in a category that's actually not the easiest category, in a lot of different ways. And I think if I remember correctly in our last conversation, you raised Series A at a point where the business was not necessarily, like ahead of like Series A benchmarks. And so like, what is your decision making, sort of light post? Like how do you think about what is the right time to go into Series A?
So I think all the components that Sasha talked about is absolutely right. Like timing, metrics, stage, ICP, which kind of investor are you going to meet for your, you know, round is really important. I think also naming is really important sometimes. So a lot of the founders, they go out, raise the first round as seed, right? You can call it pre-seed, it's better. Right? When you could raise like one round like lower than your actual business metrics is, that could be way, way better. So like I think there's a lot of things with when it comes to story, but I absolutely agree with Sasha around like getting your story together, understanding the objections in the market. And that's really easy to know. If you talk to like 10 investors, they're probably going to tell you the most common objections that are going to come from like most of the VCs, right? So like getting the story right is the first thing you want to do. I think with A, we did something really good. And I'll tell you what we did. It wasn't necessarily in terms of metrics ARR. So our ARR was like 700K, something like that. And we raised it almost 100 million valuation. And the reason was we proved a ton of value with a few customers that if we replicate this with all the new pipeline or the new customers, we'd be very sticky, right? And I like to say when is the right time to raise an A or a B or a C, I think is when you feel like if you can fund, like if you have all the money in your bank, like if you have $30 million in your bank and you would fund the business and you would lead the round, is the right time to raise, kind of. If you still are shaky about what's going to happen in the future, you can't see pipeline, you can't see demand, but you still want to raise, I think it becomes really hard to raise. But when you feel like you can fund the entire, like you want to spend every single dollar you have because you could see that cash printing machine being built, I think could be the right time to go out and raise. I think that's the way I like to do it. I don't like to fake a lot of things that I have. So basically just go back and work on the business, see the right levers I can pull to make it, a better business, and then go out and raise when I feel like, yeah, if I took this 50 mil, I'm gonna make them 500 mil, right? So
Right.
other than
I
that,
want to point out two things in here. One, he said I'm right. So if this is recorded, I need a clip for my wife, which I appreciate. But two, you have to also remember, like I think you brought up a really good point that I want to reemphasize, which is an investor is investing in you a certain amount of money at a certain valuation, not because they think that is where you're going to end up. That's the starting point. They want to make a 100x, a 50x, a 25x return on that capital. So you have to tell the story not of why you're great today, but why you're going to be generating that revenue and that cash flow for the next investor. So remember, a seed and a Series A's primary metric of success is you raising another round of funding, right? It's not that funding round. That's not like I made it. Are you going to continue to grow to attract the next level of capital? And that means you have to make them a lot of money. And then you have to show them that you're going to make the next investor even more money. So I just want to point that out in your story. You have to have a convincing story about how you're going to make them even more money going forward, not just how you got to where you are today, but what does the next 18 to 24 months look like? Are you going to make them another 50, 100, 200, $500 million?
exactly. You're selling
No,
potential. I think you're selling the potential price of the stock. You're not selling the stock today. So that's like where you have to think, do you ultimately believe that the machine you're building is going to generate that share price, right? And then you have to think about it. And if the answer is no in your head, but you still want to raise, you can, but it'll be very hard to raise. Yeah.
right. No, and Umar, I love the perspective around like, would you invest $30 million in this company? And do you have conviction that it's going to turn into, 500 million? And if you have that, then that's a good time and good sort of inflection point to go and do that. Would love to switch gears and talk a little bit about, a very important topic. It's like super relevant, for fun in life, but particularly for fundraising, which is luck or the role of luck, or, this sort of idea of like, running into good luck or manufacturing luck, right? And, I think, a quick anecdote, with my first company, we got really lucky with our Series A. We spoke with like 30 VCs. We're not getting a term sheet. It's a very, very high burn business in consumer transportation in emerging markets. So it checks all the difficult boxes, right? Emerging markets, high burn, consumer transportation, right? And no one wants, it's like your burn is like crazy. It's doubling every month. Like this company's going to blow up. We don't want to put millions of dollars into this. And then we got lucky. And the way we got lucky was we started looking at like what are investors that have made money in consumer transportation, right? So we looked at like who did Uber, and First Round was right there, and we spoke with First Round in 2 calls. We got a term sheet, massively oversubscribed round, in a couple of weeks. And so that's like we did get lucky, and you do get lucky. And I think there's some aspect of like manufacturing luck where you're trying a lot of different things. And for us, we got lucky when we tried like looking at or pursuing or talking to investors that had made money in consumer transportation. Other areas in your experiences, such as you've raised so many rounds, like what are instances or areas where you feel like you got lucky, and like as you look back in hindsight, were there things you did that somehow indirectly or directly contributed to that luck? And is there a lesson there in terms of founders on the call?
I mean, yeah. What is there some saying that I will mess up around sort of, being prepared? Luck is for the blah, 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 something prepared. So like, if you're prepared when luck happens, then you can take advantage of it. But like, luckily having to run into a VC that wants to invest in you and not being prepared with like your story and your pitch deck and your data room and your whatever, that's bad. And having everything prepared and then like not creating the luck for yourself is also bad. So that's why I live in San Francisco. Do I want to live in San Francisco? Maybe. I don't know. It's pretty expensive. Like the schools here suck. I got 2 kids. I live in a smaller place than I could out in the burbs. But like, what am I optimizing for? I'm optimizing for having those moments where I close a partnership, where I close a VC round of funding. Almost all of my funding rounds and major partnerships have come over 50% have come from me being in San Francisco, going to events, showing up, and being prepared. Now, could I have done it otherwise? I would like to say I could. Would it have been easier? No. Like I got a partnership with Stripe because I happened to be here at a happy hour and I happened to meet a PM that I'd happened to meet a year before who was a founder who sold her company and she worked at Stripe. And I told her what I was doing and she's like, oh my God, we've been looking for this. We just had a meeting this morning. Let me connect you to the partnerships team. Connect me to the partnership team. And then we had like our first distribution deal. And I was like, oh, wow. And then I talked about it with somebody else and like, oh, you're working with Stripe? And Brex was like, oh, let's do this because Brex's offices are like on the other side of this building. Could that have happened otherwise? Maybe, maybe not. But it happened because I was prepared. I had a story. I had a prepared mind. And I ran into people at, an event or at the coffee shop. And so I think luck meets preparation is like great. Now you can't bank on that for success. I can't fundraise on like, I think I'm going to run into somebody at Stripe who I happen to meet, who is a PM, who happens to be on the partnerships team. They're going to be leaving in 3 months and they're going to not really give an F about anything else. And they're going to introduce like, no, that's not a business strategy, but it helped with fundraising. I mean, it helped me build a better business, which then helped with fundraising.
That's great anecdote there with Stripe and I think San Francisco and the sort of decisions that lead you to sort of have a high probability of running into good luck. Omar, anecdotes from your end. Are there instances you've gotten lucky where are there lessons in terms of running into good luck or manufacturing good luck that you want to share?
I think Sully existing is just the definition of there's no luck, right? So we're not doctors. We pivoted from a company in YC. We raised 40 million and we're scaling pretty quickly. So like having a SF company, we were, by the way, pivot. I think Usman, right? We were a pivot from the Middle East. So we were a company in Dubai. So just like I would say luck, me being here is a definition that luck is just a formula, I would say. And yeah, I agree with Sasha 100%. Like chance. I had this written actually on my whiteboard, like chance or luck favors the prepared mind, right? So
that's what it is.
Yeah. I had it on the whiteboard actually for like a year inside my apartment, and it's like everything was around that word. Like if I wanted to document anything or like take notes, it was just around that sentence. So I think you can definitely manufacture luck. And as Sasha said, SF is, yeah, could be like, not the best city in the world to live, but it's the best city in the world if you want to build a company, right? So if you say you want to build the biggest company in the world and you're just in, another city because you like it there or the lifestyle is better, then it just says a lot about you. So yeah, absolutely. I took a flight. I think you, Usman, we met in SF. I took a flight to SF and I didn't know anyone here. I didn't know like people were like, what the fuck are you doing here? So but yeah, like we just like, took the first step. And I think there was one of the books, I can't remember which book or an article that was mentioning that the location, and like people and location is almost 80% of the formula. So if you really want to build a tech company or a forward frontier, like applied AI company, and you're in like another city that's, favors more Hollywood actors or something like that, that's the wrong place to be, right? So 80% is about location. I think that was one of the quotes that I read, and instantly I just booked the ticket and came to just got to SF and started building. Like space
Awesome.
company.
Well, I raised my first round of funding for Puzzle because I happened to be at SFO Airport flying to LAX, and there was an investor that I recognized from LinkedIn, who I met before, but like I recognized and I hadn't talked to in a long time, who was also sitting at the airport, also flying to LA on the same flight. And I was like, sit down next to you, like, let's pitch time. I know you're waiting for the same flight, so let's go. Like, I know that's not San Francisco proper, it was SFO, but like that's how that was my first round of funding for this company. Was it started from seeing an investor, Nico, at the airport and being like, yo, we're catching up.
Right on, right on. I think hopefully by now everyone's convinced to move to SF if they haven't already. But I think it's a great analogy and a great sort of anecdote. I think those are the sort of decisions that help you sort of manufacture luck and run into good luck. Um, let's switch gears here. Let's talk about mistakes. And I think there's setbacks in fundraising. There's like what are some of the most glaring mistakes that maybe Sasha will start with you that you've made that you look back and you're like, wow, like how did that happen? And then there's we've all sort of been there where there's like a very important investor call and you blow it up and you sort of tell the wrong story or you sort of come in from an angle that just like it's and how do you deal with those setbacks? When there's like an amazing investor, it's your first round, they want to lead, and then after this call, it didn't go well, and it's because of maybe lack of preparation, or maybe you just like didn't get it right in that one moment. And so what is if you've had those moments, like how do you come back from that?
Um, I was trying to think of like a good analogy of like a story to like kind of bring these things to life, because you could make most of the mistakes are obvious mistakes in hindsight, and obvious mistakes when we're listening on the like this webinar or podcast, and then you like are in the middle of it and you just like lose all sight of like reality. So what are triggers that are wrong? An email came in from an investor, really an AI SDR, masses investor, and you go, oh my God, like this fund just reached out and wants to meet with me. And you're like, yeah, okay, are you ready to be meet? Like, it's like, it's like going to a bar to go try and meet your wife or your partner or whatever. And you're like, you haven't worked out in like a couple years, you're dressed like a slob, you didn't brush your teeth, like, you're not ready to go meet your future wife, partner, whatever, if you're not ready, just because they happen to be there. Like, don't make your bad first impression. The second is fundraise when you're ready. Like, you either got to fundraise or not fundraise. And so going in without a story, without your like data room, without your narrative, without your business to be ready. Again, bad time to go out. Like, if you just watched a sad movie, you just broke up with somebody, you don't expect to meet your wife the next meeting with like the first date or whatever. Second is like, tell your story. Similarly, when you're dating, I don't lead with like, yo, there's a history of mental illness in my family. And like, I'm like kind of a little bit of in student debt right now. And like, you share that, obviously you got to be transparent, but you share to the end. You got to build them to like you, show up your like good stuff first. And then like you ease your way into like full transparency and disclosure. But I'm not like leading, walking around being like, I have a history of mental illness and I'm in debt. You want to date? Like, what do you think the answer is going to be? No. Like, right. So tell your story, be prepared, be ready, and do it on your terms. You could always build your CRM. You should of accounting, but you don't have to reply in that moment. It's not really a human on the other side being like, oh my God, you know what I've been thinking about my whole life, investing in you and your company at this moment. No, they're spraying and praying to everybody. They're trying to get meetings. They're trying to fight for your business. They'll be around next time. Like, this is not like, you are amazing. You are a great founder. Don't get me wrong. But like, you don't have to respond in that moment because AI sent that message, not a human. And they're not just like pining away. You're the only email they sent. They're blasting every email that their algorithm, like that they can. Every email that Clay possibly sets up, like you're getting email. So, do it when you're ready.
Right on. Awesome. Omar, big mistakes, small mistakes you've made along the way that you wish you hadn't made.
Oh, so many mistakes in fundraising. I think the biggest thing, so other than like, I think being ready is one thing, which is, I think is fundamental, but the timing of the round as well. Like if there's, for example, if like a bunch of deals is going to close in, 2 months from now, or like a month from now, I would actually keep the round, quiet until, you start seeing, or you're about to see momentum, because these kinds of momentum, you going from like 500K to 700K from the time they first talk to you, and like a week in, it gives a really big signal, right? Like this company can scale, this company should scale. So I think like around like timing, ARR, momentum is really important. Like timing is not just when you're ready. I think it's also what the market, like what can you leverage from your business, and then also what the market says. So one of the big things I would say in AI healthcare, we were raising when like Epic was launching their AI products, and like all these companies, Oracle launched their AI suite, and so like not moving fast enough in the round could maybe kill your round. So for example, we had like we started raising the A, and then the PR for Epic went out, right? So we had the same night an objection handling sheet for all the things that came out on Epic and why Epic wouldn't kill us, right? So you have to be really fast with moving in a very competitive market. If you're raising in a very competitive market, in the process, you have to answer these objections very quickly. You have to come up with the answers very quickly. And then running a long process, one of the biggest mistakes. So like saying you're raising on you don't want to close around in like 2 months, or like you want to close it in quarter 1, versus just meeting everyone in the same week. So I think one of the good things we did in Series A is we met 30 to 50 investors in just 1 week. We're like, we're going to decide on 1 or 3 partners. And I was like, hey, I have a paper here. I'm going to write your name on it or not, right? So depending on this meeting. And I'm only going to write 3 names. And then they would see like 1 name, right? So they feel the FOMO of like the 2 other spots that are there. So, and I was like, and I'm sorry, I was like, hey, I'm running a really tight process. Sorry that I'm saying this. You could be a great VC, but not just great for us, right? And then it's just have a conversation. So it was just like very, very tight process was one of the mistakes that I did before raising the A. So I failed multiple times at raising the A. I failed multiple times raising the seed for like some of these reasons. So
Yeah, sort of the connecting tissue between, what you mentioned around like just, an email came in, I'm going to respond to this, and what Omar is saying around, timing that. I think the connecting tissue is like being intentional, right? Like a lot of times, right? And I've made that mistake, right? Like where you're not raising, but you are sort of responding to investors, and you're hopping on calls, and you're sort of, and there's no sort of clear clarity of intent, right? Where we're going to start this round at this specific point, and this is why, and we're going to like take 8 weeks to get done with this, right? And you sort of run it in a more intentional manner. So spot on, and I think there's a question in the chat that really sort of touches this, right? So Sasha, maybe I would love for you to, what are your thoughts on time boxed fundraisers? I.e. saying we're targeting closing the round in 3 weeks.
Well, I do believe in time boxing it. I don't believe in setting a date, because if you don't hit your date, you're dead. right? You could set an internal one. Like I'm gonna internally give it my all for 3 weeks and see what happens. Cause like then the business suffers. And if not, I'm gonna lick my wounds, revisit, figure out what went wrong, fix the story, fix the business, fix whatever and go out. Don't ever tell an investor, I'm gonna run a process for 2 weeks to do this. Because you know what happens in 15 days? You're dead. You're not getting fundraised. And the most powerful whisper network is the VC whisper network. Once you're sort of tagged as dead in the water, you really have to find an outsider to invest in you. So I would say, yes, mentally try and time box, but that doesn't mean like I'm just going to start today. It means like have your deck ready, have your deck prepared, have your deck vetted, have your data room ready, have all your contracts ready, all your employment, have everything ready. Then try and do it in like 3 weeks time, like, or whatever your right time frame is.
I agree
Also,
with
like set a
Sasha.
reasonable time frame. What's that?
Yeah, no, I agree with you, Sasha. I think we set a time where we're gonna pick 3 partners to dive deeper with. So we don't set a time for the round, right? And we'd say like, hey, we're meeting investors in like this week and a half. We're gonna just pick 3 partners to dive deeper with. So there's technically you're right, Sasha. Setting a date would kill your deal, right? Sometimes they would say, oh no, we can't do this 3 weeks. But then we're like, hey, we're just picking partners to dive deeper with. If you have enough interest based on a few things you've seen, you should have a little bit of conviction to say, yes, I can dive deeper with this company, right?
Yeah.
So yeah, I agree.
I like that. I like that too. I sort of do something similar. I just sort of tease it as like, hey, we're going to go into market in like a month. I'm going to give you 3 people. I'm going to give 3 firms that I think are like good fits, a 4 week head start, and then I'm hitting it. So this is the date that I'm going to go out. But if you guys want to dive in, let's go, or something like that. So I do something similar to also, I like like trying to drive FOMO of like, you get an early peak. I usually do like 2 weeks. You get a 2 week early head start, and then I have everything ready. And on like, Monday, the blah, 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 I'm blasting everybody.
Right. No, this is an excellent point. And just, for everyone on in the room, signaling theory is, so sort of central to fundraising, right? Like if you say you're going to close in 3 weeks and, it's the fourth week and you haven't closed, all these investors, that you're speaking with, they're going to think, oh, you're not able to close, or no one else wants to invest, right? And so, that's sort of the problem with, committing to a timeline, because fundraising is inherently, not as predictable, and 3 weeks could be 6 weeks, and six could be 10, and so on and so forth. And I think it's also why you don't want to, tell investors the names of the other investors you're speaking with, because, again, signaling theory, if firm X knows I'm speaking with firm Y, and they find out firm Y is not investing, it sends a negative signal, and then, that influences their behavior. And while we're talking about this, I think one of the big sort of really interesting and important topics in fundraising is like around momentum and competitive pressure, right? And Sach, I think you mentioned that briefly, where you maybe you're close with an investor, like, look, I'm going to give you 2 weeks heads up, right? And then I'm going to open the access to the data room on January 20th, but I'll give you access 2 weeks before everyone else, right? I think it's an excellent example of building momentum and building competitive pressure within the you know what are other thoughtful ways in which you've built momentum into a round? And by the way, before making it tactical, like how big of a role does momentum or competitive signaling play in venture rounds?
I don't remember the number, but the directionally, it might have been, was it Peter Walker from Carta or something? There was some analysis by somebody that was just sort of like the looked at the distribution of term sheets. And I don't know how you validate this, so it could have just been a survey amongst founders, but it was something like the overwhelming majority of people got either 0 or 2 or more term sheets. And so the minimum value was 1 term sheet. And so it was, you probably have data on this too, maybe, but it's like, you either get none or you get multiple. And so I think that sort of goes to show that FOMO and momentum like drive outcomes. And so I would say, based upon the data and my own personal experience, a lot. It matters a lot.
Right. Right. And I guess, more tactical, or if feel free to chime in, but like, how do you go about building momentum? Is there, a specific approach?
Use
Um,
metal.
One day, metal is going to be good enough where you can just say, "Hey, I want to build momentum, do everything," and it's going to do it. And I think we're going to get there before the end of the year. Um, but and Omar, he's actually a power user of metal, and he actually, is one of our early customers, and he angel invested in metal, right? And he's been hitting me up on WhatsApp saying, "Hey, like, I need CLI access. I need MCP now, right? You want money? I'll give you money. Just give me MCP access. CLI. I'm done with this UI. Like, this is over, right? We've moved
Yeah.
on. Um, but yeah, Omar, momentum. What's been, what's worked for you in terms of like building momentum, especially when you don't, no one wants, let's say you're opening a round, you don't have a term sheet, right? You don't have investors saying, "Hey, I will invest," right? And so before that, how do you go about building momentum?
I know this is really hard to say, and I'm sorry for saying this, but if you can build or get the company in a place where you don't need capital when you're raising, or at least you can, if you double your revenue, you're going to be good for another, 1 year runway or something like that. You can get the business there. That could be the biggest thing. But I think if you don't have a term sheet, the ultimate thing that you can build momentum with is, revenue or ARR or traction, right? Is that you're doubling your revenue, right? So if I double my revenue, I'm not going to take that same valuation, right? Or company valuation will double, right? So I think the ultimate way to build momentum, if you don't have a term sheet yet, I think the ultimate way to build momentum for a funding round is having a term sheet. So if you have a term sheet, everyone wants to give you a term sheet. So, but then if you don't have a term sheet, like who the fuck is going to start? So, but I think I would say like deals about to close can build a lot of momentum. Traction, exciting talent joining the company, like all these things can build a lot of momentum because it can answer the objections that they have. Like, are they able to hire great leaders? Are they able to, get a good team around them to build this out? Are they able to close customers? All these things. So I would say the biggest thing for momentum would be like traction, and I would say customer. So one of the things that I did was like, hey, we're signing this big deal. If it closes and we ramp it up, we actually don't need any money. So we don't need any money at all. We were 6 people at the Series A. So we're like, we're gonna be fine. So we're like, and they were like, oh, wait, when is it closing? I was like, it's gonna probably close in April. Can we talk to that? Customer's like, yeah, you can talk to them. You know what I mean? So they ended up doing the round. Another way I would also see momentum is if you're raising a smaller round, like pre-seed seed, angels. I love angels because I think Usman, when me and you met, I can't even remember you telling me any ARR or revenue. I didn't even know that the platform was up. I didn't even go on the platform, right? It was just like your story. You wanted to build another big thing, right? And it was just like, an investment. And there was no diligence, there was nothing. And I got one of my biggest investors a seed to write up to 2 million with he didn't even see data room. He just heard the story, talked to me for little bit, and ended up investing. And I think that could be an anchor to the round as well. They could lead a 6 million round with 2 mil, right? And if you can position them to lead, then you can anchor the round with a kind of term sheet, right? But it's not a term sheet; it's an angel who wants to lead. So
Right.
we did that in seed, and but not in A. We did that to anchor seed. We got an angel investors really gave us like 100K earlier, but we knew he could give us the 2 mil. So we kept like updating him, telling him how we built. We invited him to our office, showed him everything. It just like started becoming vested, right? And he's like, I would just do 2 mil for the next round, and I was like, let's anchor around then, and that's how we built momentum around seed. Yeah.
So there's two powerful ideas here, right? One is like business momentum, right? Your ARR is growing, you're hiring great people, right? Like, some of the best talented people are joining the company, right? So all the business stuff can, it's like one sort of way to drive momentum. And then the other one is like just getting an anchor investor, right? And that drives momentum. But Sasha, I want to go back to what you said, right? Which is like, something really interesting, right? Like, let's say you don't have amazing metrics, right? Let's say you're raising a seed round, you don't have amazing metrics, and there isn't a whole lot that you can use incredibly from a business standpoint to build momentum, right? And so that sort of leaves you with just running the process in a way that helps build momentum, right? And so like, you said something really interesting about like, hey, I'll give you access, 2 weeks ahead of everyone else, right? And I think in communicating that, right, like you are already setting the stage whereby, the other party knows that there's a lot of other people around the table, right? And so like, help us unpack that. Like, what are things, you can do when you don't have a lot of, you know, um, revenue traction and business momentum? Are there things you can do from a process standpoint that can help build momentum or architect or design, around for momentum?
Well, I'll say the first caveat is like, if you don't have any business momentum and you don't have revenue momentum and you don't have customer momentum, like maybe you're not a venture backable company. And so I think the first part is there's different ways to build a business, and the venture path is you are giving up control with the understanding that you are going to work all of your nights, weekends, and evenings to build a growth business. You have to be growing at least triple digits for years to come, whatever it takes. So if that is not possible, or that's not your business, or that's not your ambition, or you want to have control of your company, the venture path is not a good one, because that's what the venture path is. So if you want to bootstrap your business, that's totally cool. You can always raise venture later when you're ready. But like, you have to make some changes. So I guess the first thing would be, just if you don't have a skeptical mindset, go to ChatGPT and write, or to Claude and say, pretend you are a very skeptical top tier investor, and here's all of the things about my business. What do you think? And if you don't want to hear it from me, it's better to hear it from somebody. You probably don't have a venture backable business. Now, how do you change it? You got to figure out how to grow. Like you got to figure out if the capital is the thing that is the only reason you can't grow, what is the thing that convinces you that will convince somebody else that you have something that matters, right? Can you build it? Does anybody care? Is anybody going to pay for it? Like how many people are going to pay for it? How much money? If you're just like, oh, capital is the reason, your VC doesn't like want to give you capital to learn. They want to give you capital to like grow and build a business. There are cases where capital is a constraint. Sometimes hardware businesses, or like supply chain businesses, or AI businesses. Sometimes there's upfront capital needed to prove it out. That's hard, but you can find it. But if you're like, I built something and it just isn't growing, but like give me money and maybe I'll figure it out. That's like not a really compelling reason for somebody to give you money, whether it's my own $100,000 or whether it's a venture capital. Like, there's thousands of people like you who are growing. Like, I'm going to give money to them because growth begets growth. And so I generally think like figure out how to grow.
And what Sasha said about like ChatGPT, I've seen investor in like partners doing that with ChatGPT. So they're taking your materials, uploading it on ChatGPT and asking it questions. So like you better off you go to it first. So
Yeah.
that's a really good thing. And I think so. One thing I would say, Sasha, like the last thing you said about like if there's no growth, then that doesn't apply to me. So by the way, we did not grow as fast. So we went from 0 to 1 in the first year, but we had a story that was real. We didn't fake the story. It was like, here's the customers. We could have been at 3.5 million. We said no to 2.5 million customers. And here's why. And we showed why we said no. The roadmap that they want to take the product in is not aligned with our vision. And that's why we think, yes, we might take more time to get to 1 million, but once we get to 1 million, it'll be very easy to get to 5, right? And we actually did. We went from 1 to 7 in the second year, right? So, and now we're going from 7 to 45 this year. So like, and we just basically had an explanation around it where like the LLMs today, they're giving you an answer, you're going into the reasoning. Why did it give me this answer, right? So you have to do that. Like if you're not growing as fast and you still believe in the business, you have to also build a story around like, why is it not growing fast? And are you like, and show the potential. Like you show like $6 million in deals that of customers coming to you, but you're saying no to it. You're choosing to have slow growth to build a great product. That's also a great story, right? And it also shows momentum, by the way, because you're showing a lot of customers that wants your product. So I think like maybe that's not the case with you, but I think like try to build, like understand the story, make it make sure it's a real story, and then simplify it to investors. Like, hey, yes, we're not growing like 0 to 7 million in 48 hours, like what you see on Twitter, but we have a reason why. And I think that could help investors. Just, it's like you're getting them into the company and showing them, like, what are we building? What are we burning the money in? How much money are we, how much money are we think we can make from this machine, like, and when it's done, right? So I think like that's one of the things that I would say.
Right.
You don't have momentum.
And I would argue, going from 0 to 1 in the first year is actually, terrific traction, or anything in that direction, right? Where, if you're just like flat, not
it's
growing.
Slow nowadays. Usman, 0 to 1 is like you're an
right.
old 89-year-old starting a startup. So,
yeah, I mean,
slow nowadays, right?
this whole idea of like 0.1% of companies driving 90% of the narrative, right? Like, it's just, but we're gonna take some questions from the chat for a couple of minutes before we wrap up. So, there's a question in the chat around signaling. The question is, can you talk about signaling around the amount to be raised? Let's say you want to raise 5 million. Do you go out looking for 2 million and then let it grow from there?
I'm up for a lower amount, to be honest. Sasha, you can go, but I'm up for a lower amount and then build a FOMO around the lower amount. It gets subscribed very quickly. Then you can go up to 5. Like every single time we went out, 3 million seed ended up closing 8 million seed. 15 million Series A ended up closing at 30 million. That's my approach. Could be different. Some people don't like that approach.
Yeah, it's like it's a double-edged sword. Like when it works really well, and when it doesn't work. So I would say if you need 5, don't ask for 2. If you want 5, but 2 works to hit a milestone, like the number should tell a story, and you should have you should have it. So it anchors really well. Like with Omar, he's like, listen, for 15 million, I'm gonna hit my next milestone, but for 30, I'm gonna do this. Like that is a much more compelling story than like, I need 5 to hit a reasonable milestone for the next round or the next big thing. But if you give me 2, maybe I can cut this out or cut that out. It also sort of signals sometimes your ambition. So it depends who you're talking to. So if you're talking to like a big company and you're like, I need 2 million, and they're like, how ambitious are you? Like if you like listen and watch Omar, he's ambitious. So he's like 2, and you're like, you don't want 2, you want 5. And you're like, yeah, I want 5. Let's go. So, if you're, Travis Kalanick, you're going to ask for $1 billion, and you're going to put that to use. So like, it kind of depends. I think the most important thing is have a hypothesis about what milestone each of those amounts of money do. But yeah, generally, like if you ask for a lower amount, it's easier for seed and Series A fundings because like some firms can't write a $5 million check. And so then what they do is they're like, here, I'll give you 2, but it's conditional on you going to get the other 3. And now you're like, oh, like now I don't get like, so just like, I like the ask for a slightly lower amount, but say with a bigger amount, I can go bigger because VCs like that story. Like you have kind of 2 stories to come in or be prepared. That's another path.
Right. I couldn't agree more on that, right? Like if a VC is finding out that you wanted to raise 3 million, but there's too much demand and you're now raising 4 or you're raising 5, right? Like that's an endorsement to them. Like there's a lot of interest around the table and that kicks in, and herd mentality and momentum and all of that. Just like one final question. It's a great question. It's a loaded question. What's a common mistake founders make when prepping their data room?
Well, so let's go assume that you just have all of the things. I would say the biggest mistake is their financials and their story don't match. Like you're like, I'm going to do this
100%.
thing and whatever. And you're like, well, what's the capital you need? I need $2 million. But the story I'm doing is like, these things are disconnected. And so just connect the story. Like you can put it in ChatGPT and say, here's my financial model, here's my story, do these things match? But like make sure they match, because there's a lot of the people, the tech, the time, needed to these things make sure these things tell the story together.
Absolutely.
100%
Omar,
agree with Sasha. 100%. Yeah.
Awesome. Sasha, Omar, this has been great. Thank you so much for sharing this earned wisdom. Great way to give back to the community. Thank you so much, Sasha from Puzzle, Omar from Sully.ai. Thank you, everyone. Thank you, everyone, for joining. Thank you. We'll wrap up here, and we'll host more of these events. Thank you, everyone. Cheers.